Hello everyone, welcome to today's session. In this session, we are going to talk about tax declaration investment and we are also going to talk about the deductions available under the regimes. We are going to do a comparative analysis between the tax regimes. My name is CA Saikat Roy and I have been part of Clear for last 5 years and I welcome you all in today's webinar. In Before starting the webinar, I must tell you something that on 1st of February 2024, our Finance Minister Ms. Nirmala Sitharaman has tabled the finance bill. Now, in this finance bill, since this was an interim budget, there has not been made any changes whatsoever. However, uh, once the election is over and government is elected, in that case, a new budget will be tabled and there will be some financial changes. So, if we are looking for any update on the budget, that will be the budget to look out for. And this budget will be presented once the election is over and a new government has been elected and assumed the office. Now, having said that, let's try to understand what we are going to talk today. Now, we are going to talk about the tax planning options. We are going to see the slabs available under the tax regimes, and we are going to answer a question that which regime is beneficial for a person, and what and when you are supposed to invest the proof or submit the proof, and what happens if you do not do it. And furthermore, we are going to take a look at certain issues that crop up during the year. Now, before starting the session, we have to understand two things. Number one, that tax saving can happen on two items. Number one, on certain expenses, and number two, certain investment instruments. So if you are incurring certain expenses, in that case, provided you are meeting with certain criteria, conditions, you will get a tax exemption, tax deduction rather. And if you are investing in certain investment instrument, in that case also you will get a deduction. However, there is a small difference between tax saving expenses or deductions. Now, tax saving expenses or allowances, they get directly deducted from your taxable income, right? So if you are getting salary, from that salary income, the allowances etc will be deducted. And deduction in the form of allowing you ATD deductions or ATC deduction, that actually happens after the taxable income is computed, right? So there are these two levels upon which tax saving expenses and deduction can be allowed. Now, having said that, let's try to understand what are the expenses that can give you certain tax benefit. The first example of tax saving expenses are house rent allowance. Now, there are a couple of misconceptions regarding to the house rent allowance available. We are going to address them in this session. Firstly, we must understand that to claim house rent allowance, this allowance needs to be part of your taxable salary, right? It should be part of your compensation. Think it like that. You have a savings bank account, right? Now, if you have 10,000 rupees in that savings bank account, then only you will be able to withdraw any amount up till 10,000 rupees. But if you do not have a savings bank account, there is no way you can withdraw certain amount from that savings bank account. These allowances work in the same lines of that. Until and unless you have allocated a certain sum of money in certain allowances, you will not be getting the benefit of those allowances by way of deduction. So, while claiming the house rent allowance, please make sure you have house rent allowance component in your salary. If not, then you need to allocate this into your salary. That is the first criteria. Second criteria is you need to be staying in a place which is taken out on rent, and you are taking that place on rent to perform your duty, right, for your employment purposes, right? So we have seen certain situations wherein the person is actually not paying any amount of rent, right? Maybe that person is paying rent for a place which is nowhere near the city in which he is there on employment. Maybe their parents are staying in a rented place in his hometown. Now people try to claim that amount as HRA, right? So simply this is not allowed. You have to take up a place in your place of employment, in the city of your employment, and you need to stay in that rented place so that you can fulfill your employment duties. Then only HRA will be present. HRA deduction will be deducted. Third thing is that any amount of rent that you are paying, that is directly not deductible as house rent allowance, right? Now there are three figures. There are three figures that need to be considered while computing the house rent allowance deduction. Now what are these three figures? Number one, the actual amount of HRA that you are receiving, right? So that will be already present in your payslip. Number two is 40% or 50% of your basic salary, that this percentage of 40% or 50%, that will depend upon the city that you are staying for employment purpose. If you are staying in one of the four metro cities, that is Delhi, Mumbai, Kolkata, and Chennai, in that case 50% of the basic will be considered. In case of all the other cities like Bangalore or Pune or Gurgaon or Noida, in case of all these cities, 40% of the basic will become another consideration point. And the third point for computing all the HRA is whatever amount of rent you are paying minus 10% of the basic. Out of these three figures, that is actual amount of HRA, 40% or 50% of your basic, and actual rent paid minus 10% of the basic, out of these three, whichever figure is the lesser amount, that will become your house rent allowance deduction. Again, house rent allowance deduction is available under the old tax regime. It has no holding under the new tax regime. Now, second point of expenses that can be taken as allowance, as deduction, is leave travel allowance. Now, leave travel allowance is in short, in nutshell, is an allowance which your employer is giving you for your traveling purposes, right? Maybe you are traveling for your during your holidays, right? And if you are undertaking the journey, in that case certain expenses can be allowed to be deducted. Now let's dive deep into this, right? So leave travel allowance is allowed to you twice in a block of 4 calendar years, right? So if you are traveling multiple in multiple years, right, in that case uh, only two travel can be allowed as deduction, right? And the deduction will be given out in 2 years out of 4 years in question, right? So 4 year, this 4 year block has started from 2022, right? So presently we are at the third year of the block. All right. Now, what are the other conditions? Firstly, the travel needs to be undertaken within India. All right. If you are traveling outside India, then those expenses are not to be allowed. Secondly, only ticket expenses are allowed to be deducted. Now, ticket expenses in this context would mean either flight ticket or train ticket. No other means of transport is allowed to be deducted, right? However, there is a very limited option wherein the some areas are not covered by this train or flight network. In that case, some other mode may be considered. Now, the point is may be considered. It never says that it will be considered, but maybe, provided those places are completely outside of the purview of travel network, of flight and train, right? And you need to consider always the main cities of the travel, right? Maybe you are traveling from Bangalore to Shimla, so the flight ticket from Bangalore to Shimla is to be considered. From Shimla, if you are sightseeing here and there, those expenses are not to be considered, even though there is no railway network, right? So main cities need to be targeted or considered. Now, what type of train ticket or flight ticket are allowed? Uh, Train ticket, if you are traveling up to first class train ticket, then only it will be allowed. So you can travel AC 3 tier, AC 2 tier, or first class. These all expenses are covered. Number two, if you are traveling via plane, in that case, economy class flight ticket are allowed to be deducted. Now you can take your dependent children with you, you can take your dependent spouse with you. Those ticket expenses can also be claimed under leave travel allowance. Also, leave travel allowance is available under the old tax regime. It does not have any standing under the new tax regime. Now, there are also certain other expenses for which you will be able to claim the deduction. For example, professional development, right? So maybe you are looking to upskill yourself, right? You are undertaking certain courses. Maybe you are purchasing some professional books. You are subscribing to certain professional magazines. Now, all those expenses can be claimed provided you have allocated a certain sum of money in those areas, right? So at the very beginning, I have mentioned that to claim house rent allowance, you need to have certain allowance component of that nature embedded in your salary. So all these professional development or any other items, they need to be allocated first, and then only it can be claimed. And that too after you submit a proper bill. So while doing this declaration, while doing this allocation, please keep this thing in mind. Now, what if you are not submitting the bills? In that case, it will be completely ignored. Whatever amount of claims you have made during the year, it will be completely ignored, and everything will be considered as taxable income in your hand. And consequently, your taxable income will go up, and consequently again your taxability would go up as well. Now, there is another allowance you can consider, that is food coupon allowance. So you have the option to allocate uh, food coupon expenses, right? So if your employer is giving you this option to deposit the money into some food wallet, then it can be a very good source of tax saving. Now, normally for purpose of calculating food coupon allowances, it is considered that 22 days are working days in a month. For every day, you can have two meals, and every meal can cost up to 50 rupees. So maximum amount of deduction per month you can get is 2200 rupees. Again, this is available under the old tax regime. Now, there are certain other allowances as well. So it's better you check with your employer or HR department, whosoever is in charge of these things. Some of the other popular examples are uh, this car allowance, right? Wherein you use your own car to come to office, commute to office, and certain expenses, depending on the engine size of the car, is reimbursed. Now, there are also other tax saving expenses which can give you a little bit of boost. One of such example is interest on home loan. Now, if you have purchased a flat and you have taken a loan for that, then whatever amount of interest you have paid during the year, a certain portion of that can be claimed in your income tax return. Now, maximum amount that can be claimed as home loan interest paid is 2 lakh rupees a year. That is for your self-occupied property. Now, self-occupied property in this context would mean, number one, if you are staying in that place. Number two, you are not staying in this place, in that place, due to the reason of your employment. Let me explain this to you. Let's say you have a flat, you have purchased a flat in your hometown. Say it is Kolkata, right? Now over there you have purchased a flat, you are paying a interest on that flat, but your employment is being exercised over in Bangalore, right? So to exercise your employment in Bangalore, you are unable to occupy the property located in Kolkata, for which you are paying certain amount of interest every month. In this scenario, it will be deemed that that property in Kolkata is occupied by you. Therefore, the deduction for home loan interest shall be allowed to you in this context. Now, coming to other conditions, the interest on the home loan is allowed only if you have possession of that property, right? If the property is still under construction, you are not occupying it, in that case the interest on that loan shall not be allowed to you. However, it will not be blocked to you forever. Once this house is completed, whatever interest you have paid during the construction period will be allowed to you. Only catch is that you will not be able to claim the full amount at one go. It will be allowed to you over a period of 5 years. One. Two, maximum amount of interest, including that year's interest plus construction period's interest, 1/5 of construction period's interest, cannot be more than 2 lakh rupees. Now, let's try to break this down with an example. Let's say in 2020, right, 2020-21 financial year, you have purchased a flat which was still under construction. So in that year, you have paid, let's say, 2 lakh rupees, right? In the second year, that is 21-22 financial year, you have again paid 2 lakh rupees and the house was still under construction. On the next year, that is financial year 22-23, the house gets completed. Now, in financial year 2023, that is assessment year 23-24, in that year's filing, you will be able to claim the full amount that you have paid in the financial year 22-23, right? So let's assume you have paid 1.5 lakh rupees. So this 1.5 lakh rupees will be allowed as deduction to you. On top of that, 1/5 of the accumulated amount, right? So accumulated amount over here is 2 plus T, total 4 lakh rupees. Now these 4 lakh rupees will be granted to you over a period of 5 years. So each year your claim will be 80,000 rupees. Now for financial year 22-23's filing, you will be able to claim 1.5 lakh rupees of interest paid in that year plus 80,000 rupees for the construction period, which will bring out the total interest claim of 2.3 lakh rupees. However, since this property is a self-occupied property, the interest will be capped to 2 lakh rupees a year. Remaining 30,000 rupees will not be granted to you as deduction, and it cannot be carried forward because this is a self-occupied property. So remaining 30,000 rupees will go to west. Excuse me. Now, there are certain burning questions we get regarding this, right? So let's tackle them. First question that we get is, uh, can one person claim both house rent allowance as well as home loan interest? Simply put, the answer is yes. Both are allowed to claim both, right? One person is allowed to claim both. However, certain points you need to consider, certain situations, certain scenarios, it is possible. So one of the situation that may give you the benefit is, you have purchased a flat in your hometown, right? Say, let's say it's in Delhi. The flat is occupied by your parents, right? You cannot occupy the flat because you have moved to someplace else. Let's say you have moved to Bangalore, right? And in Bangalore, you have your employment. Therefore, you cannot occupy the property in Delhi because your employment is somewhere else. So you will be able to take the interest benefit because this will become a deemed deemed self-owned property, self-occupied property. And since you are over here in Bangalore paying rent for your employment purposes, you will also be able to claim HRA, house rent allowance. So in this scenario, definitely you will be able to claim both HRA as well as home loan interest benefit. Second most common question we get in this respect is, uh, what happens or what is the quantum of interest claim in case the loan is co-borrowed? Now, if the loan is co-borrowed, specifically this has been seen in the case of spouses, right, where both the spouses are working. In this scenario, if the property is co-owned and loan is co-borrowed, in that case, both the interest component and the principal component shall be split between both the spouses, and both of them will be able to claim the amount equally in their income tax return. Now, let's try to understand with an example. Let's say the interest is coming to 5 lakh rupees, right? And there are two spouses. So both of them will be able to make a claim of 2.5 lakh rupees, right? However, since this will be a self-occupied property, this 2.5 lakh rupees claim will be limited to 2 lakh rupees, right? So each of them will be able to claim 2 lakh rupees in their income tax return. The principal component, again, you will be able to take deduction, but that will be claimed under a different section altogether. One point to be noted is this interest on that property is normally called as loss from house property. There is another one section that gets triggered, that is section 80 EA, right? Now, 80 EA has stringent conditions to claim. Now, this 80 EA section's deduction is over and above the deduction you are allowed under section 24B, the discussion we had till now. Now, under 80 EA, there are conditions which are very stringent, namely, the loan must be coming from a banking institute, one. The loan must be sanctioned between 1st of April 2019 till 31st of March 2022. The stamp duty value of the property should not be more than 45 lakh rupees. And finally, the loan should be taken by the assessee to purchase his first property. If all these conditions are satisfied, in that case, you will get a additional deduction of 1.5 lakh rupees, which will be over and above 24B. Now, there might be a question that I am not fulfilling one of these criteria, right? So someone is thinking that my loan was sanctioned on 10th of December 2018. That will be way before this one for 2019, the starting date. In that case, you will not be able to take the benefit. Someone might be wondering, the value of the property is coming to 55 lakhs and all the other conditions are being met. Will I be able to do that? The answer is no. The stamp duty value of the property must be not crossing 45 lakh rupees. If all these conditions are satisfied, then only you will be able to claim additional benefit. If some of these conditions are not satisfied, then you will still be able to claim deduction under section 24B, that is up to 2 lakh rupees, which will be considered as loss from house property. Now, these were all about the expenses. Now, let's take a look at investment option under ATC. Now, under ATC, there are lot of deductions. There are a lot of deductions present, right? For example, PF deductions are present, tuition fees are allowed, life insurance premium policy paid, etc., etc. Let's try to break them down one by one, right? So PF is deducted every month by your employer, and if you look at your payslip, you will see around 1800 rupees or 12% of the basic, whichever option you are choosing, that is being deducted from your salary, for which there is no requirement for you to submit any proof. Now, that is a fixed sum. If you wish, you can contribute even more amount to employer provident fund, right? Now, if you are doing this can be considered as voluntary provident fund. Also, there is one particular provident fund available, that is public provident fund, and whatever amount you are contributing, that can be deducted under ATC. Now, children education fees or tuition fees. If your children are attending any school, college, or university, the amount you are paying for their education fees, amount you are paying for their admission, those expenses can be taken as deduction. However, if you are paying certain donations or if you are paying certain development fees, those will not be allowed to be deducted. So if you have taken any life insurance policy for which you are paying premium, that can also be come under life insurance policy premium paid, and deduction can be claimed under ATC. Point to be noted is that the premium amount, right? The premium amount cannot be more than 10% of the policy coverage amount. If the premium amount is more than that, that is, if the premium amount is more than 10% of the policy coverage amount, in that case, the deductions are not available under ATC. Now, we have spoken about the interest component, right? We have spoken about the interest component on home loan. But whatever happens to the principal component of that home loan? Now, since you are paying principal component of that home loan, that can be taken as deduction under ATC. Again, there are certain conditions. Firstly, the loan must be coming from a bank. Secondly, the house must be completed. And once these conditions are met, you will be able to make a claim for it. However, the overall limit for ATC is 1.5 lakh rupees. So please keep that in mind. Now, there is another option to claim deduction under ATC is ELSS, that is equity linked savings scheme. Now, essentially, ELSS are equity oriented mutual fund. However, there are certain distinction between ELSS and other normal equity oriented mutual fund. Firstly, unlike other equity oriented mutual fund, you have a lock-in period for ELSS. The lock-in period is 3 years. Now, since ELSS is essentially an equity oriented mutual fund, all the benefit of equity oriented mutual fund in terms of taxation shall be applicable, right? Right. However, there is certain relief on taxation. That is, if you are selling them off, equity oriented mutual fund ELSS, if you are selling them off after the lock-in period, in that case, whatever gain you are making, on that gain, after deducting 1 lakh rupees, whatever gains you have, that will be taxed at 10% rate. That will be added. That will be added by the health and insurance sales. Sorry, health and education sales, or surcharge if it is applicable. Now there are other also safer tax saving option. For example, tax saver FD. Now the tax saver FD has a lock-in period of 5 years. However, any amount of interest that you are earning on tax saver FD is taxable in your hand based on your slab rates. Now there are other tax saving options. For example, Sukanya Samriddhi Yojana or SSY, under which you can start depositing a certain sum of money into this account for education of your girl child, and whatever amount you are withdrawing after she attains maturity for her education purpose, higher education purpose, that is not taxed in your hand. Now there are other certain tax saving relatively safer option. For example, national savings certificate, NSC, or post office deposit, etc., etc. Now there is one option, that is pension plan, that can be considered as a good tax saving option as well. Now pension plan is generally covered under 80C. However, if you are contributing in national pension scheme, that is NPS, then there are certain benefits attached to it in case you are not claiming the NPS under 80C. How that works, let's try to understand. Let's say during the year you have made certain investment, right? Let's say you have made an investment in PF, right? Employer PF, for which they are deducting to around 20,000 rupees a year. You have a home loan principal going on, for which you are paying 1 lakh rupees a year. You have ELSS contribution, right? Again, it is coming to 25,000 rupees. And you have made a contribution in NPS, let's say it is coming to 40,000 rupees. Now you have multiple options to claim it, right? Let's see how it can be claimed. Number one, PF contribution you are claiming, which is 20,000 rupees. Principal on home loan you are also claiming, that is coming to 1 lakh rupees, right? So your 1.2 lakh rupees is already covered under 80C. You have another 30,000 rupees slab left with you. Now you have two options. Number one, you can claim the ELSS, which you have invested around 25,000 rupees. Another is NPS, National Pension Scheme, for which you have invested, let's say, or rather 40,000 rupees, right? Now, if you are under the opinion that, okay, I have already consumed 1.2, but if I add this ELSS contribution, my 80C limit will not be exhausted, right? I will be able to claim only 25,000 rupees. So that will give me 5,000 rupees. There will be still a bucket of 5,000 rupees left under my 80C. So instead of claiming ELSS, you go ahead and claim NPS contribution, right? 40,000 rupees. Even though you have invested 40,000 rupees, you will be able to claim 30,000 rupees, which will bring your 80C deduction to 1.5 lakh rupees. And you may think this is a very good and prudent tax saving exercise. However, it is not. Why? Because if you are not claiming NPS contribution under 80C, you can claim the deduction under a different section altogether. That is 80CCD 1B. Now, how this will play out? So, 20,000 rupees for PF contribution, 1 lakh rupees is your home loan principal. Instead of claiming NPS, claim ELSS contribution of 25,000 rupees, right? So, total your 80C will be used up to 1,45,000 rupees. There is a gap of 5,000 rupees in it still. However, if you claim the amount of NPS under 80CCD 1B, you will be able to claim additional 40,000 rupees, right? So you will be getting 1,45,000 rupees deduction under 80C. On top of that, you will be getting another 40,000 rupees under 80CCD 1B. So in this way, you will be able to claim the entire 1.85 lakh rupees of investment that you have made. You will be able to get the benefit of it. So this is how the NPS contribution actually works. Now in NPS, you can contribute through your employer as well. However, the amount will be limited to 10% of your salary, right? And the same NPS account that you are contributing can be used for contribution of your employer. Now, there are other tax saving options available for you. For example, beyond 80C, if you want to look beyond 80C, 80D, that is health insurance premium or medical insurance premium claim, that can be allowed as deduction, right? So if you are not a senior citizen, then 25,000 rupees of premium is admitted as claim as deduction. If your parents are also dependent parents are also not senior citizen, another 25,000 rupees can be claimed in case you are paying for their health insurance premium. In case you are a senior citizen or your parents are a senior citizen, this 25,000 rupees limit gets extended to 50,000 rupees. Sometimes we can see or we have seen that for older people, medical insurance companies are not providing any health insurance cover, or even if they are providing, the premium amount is very, very, very high, almost sky high. So people at this point of time may think, instead of taking a medical insurance policy, whenever the medical expenses come, I will meet it and I can claim the medical expenses in lieu of medical insurance policy paid. And that option is there. However, to claim this, the parents must be a senior citizen, one. Number two, the parents must not be covered under any medical insurance, right? So there are options wherein there are situations wherein parents are covered under a group medical insurance policy issued by the employer. However, people are under the impression, since I'm not paying the amount out of my pocket, I can claim the benefit of medical expenses that is actually going from my pocket. Now, legally speaking, these are not allowed because your parents are covered under a particular medical insurance policy. It does not matter whether you have taken it or someone else has taken it for you. Since the parents will be covered under medical insurance policy, you will not be able to claim medical expenses. That's this medical insurance policy can be issued by the state government, your employer, whatever it may be, whichever it may be. But if they are covered under medical insurance policy, they will not be, or rather, you will not be able to take the benefit of medical expenses paid. Now, there is another situation wherein it has been asked that parents are covered under medical insurance policy, yes, but they are going for some treatment which is not covered under the policy, for which someone is paying a huge amount of money. In that case, can the expense be claimed? To that, answer is no. Again, since the parents are covered under medical insurance policy, any sort of medical expenses cannot be claimed. Now, medical expenses in this context would mean any kind of procedure, any kind of test that you are doing for your parents. Now, there are also other sections available for deduction. For example, section 80DD. Now, if there is a differently abled person who is dependent upon you, whose maintenance is undertaken by you, for that, depending on the disability limit, 40,000 or 1,25,000 rupees of deduction is present. However, to claim this, you must file form number 10IA. Now, 10IA is available in the income tax portal. You need to be filing this form before filing the income tax return. Secondly, you must have this form issued by the medical practitioner, because at the time of filing this form in the income tax portal, you are supposed to submit a scanned copy of the physical form itself. Furthermore, If you are claiming this amount in your income tax return from now onwards, you need to give the certificate details in the income tax return as well. So please, before claiming this deduction under 80DD, you must be having this particular form in your hand, then only you will be able to claim it. Now, if yourself or any dependent of you are diagnosed with some specific diseases, then depending on their age, medical expenses or 40,000 rupees or 1 lakh rupees shall be allowed as deduction, right? For senior citizen, the limit is 1 lakh rupees. For all the other person, the limit is 40,000 rupees. Now, what are the specific diseases? Normally, the diseases are Parkinson's disease, motor neuron disease, leukemia, AIDS or cancer, etc., etc. Now, in case the person in question himself or herself is differently abled, in that case, they will be able to claim Section 80U benefit deduction. Now, the conditions are similar to 80DD, that you need to be having 10 IA form. You need to upload this form and submit this form in the income tax portal before filing the tax return, and it must be issued by your medical practitioner, etc., etc. So all the conditions are pretty much same. Now, if you have taken an education loan for upscaling yourself, then you will be able to claim the interest benefit for that education loan. Now, education loan can be taken for you, your spouse, your dependent spouse, your children, etc., etc. And the good part is there is no limit on how much interest you can claim. You can claim 5 lakh rupees or 7 lakh rupees of interest without any trouble. However, there are certain conditions attached to it as well. Firstly, the loan must be coming from a proper bank, not from any NBFCs. Number two, number two, uh, the loan must be completed within a period of 8 years from the date of starting repaying that loan, right? So benefit, you will be able to claim up till 8 years. The loan can run up to 10 years, 12 years, 15 years, there is no problem, but the benefit you will be able to claim up till 8 years. Now, there is one specific section for electric vehicle loan. So if you have purchased an EV and taken a loan to purchase it, in that case, the interest on that loan can be claimed as deduction. However, again, there are certain conditions. Firstly, the loan must be sanctioned between 1st of April 2019 till 31st of March 2022, right? And maximum amount that can be claimed is 1.5 lakh rupees in your tax return. Now, in the budget of 2023, certain changes has been made in the new tax regime. We are going to address those. Firstly, the new tax regime is right now the default tax regime. So if you have not selected any tax regime at the beginning of the year, in that case, all your income computation and tax computation has happened under the new tax regime. This situation can be changed. So if you have, or rather, if you have made a lot of investment during the year and you want to switch to the old tax regime, that can actually happen at the time of filing the income tax return. In the middle of the year, it is absolutely not possible. Under the new tax regime, standard deduction of 50,000 rupees is also allowed now. The slab rate has massively changed under the new tax regime. So previously, every increment of 2.5 lakh rupees would have triggered a tax change, slab change of 5%. Now, every increment of 3 lakh rupees would see a slab change of 5%. However, from 20% to 30%, there is a huge jump. And so if your income is more than 15 lakh rupees, the rate of tax on the income which goes beyond 15 lakh rupees will become straight away 30%. There is no 5% rate change in this range. Also, 87A rebate limit has been increased under the new tax regime. So in simple terms, if your taxable earning is not more than 7 lakh rupees during the year, in that case, you are not supposed to pay any taxes, right? Now, this would actually mean that firstly, your tax will be calculated, computed, and from there, whatever amount of tax is being calculated, that will be given to you as relief. So this is the option you can consider. However, you need to be filing your tax return. And total taxable income, it actually means your salary income plus your FD income or savings bank account income, all these things together, your taxable income arrives. If your salary income is say coming to 7 lakh, uh, exact, right? Salary income is coming to exact 7 lakh. In that case, uh, there will not be any tax deduction from your salary. However, if you have all the other sources of income like savings bank account interest, you have FD interest, those interest income will be added to your income, and there is chance that your total income will cross beyond 7 lakh rupees, and at that point of time you are needed to pay a certain amount of taxes. So be mindful about this situation. Now, in this budget, also a very good point has been introduced under the new tax regime, that is marginal relief. Now, marginal relief in this context would mean that uh, your tax must not be exceeding your income. Right? So, as per the earlier point, if your taxable income is not more than 7 lakh rupees, you are supposed not to pay any taxes. However, if your income is increasing by 1000 rupees, the if we calculate taxes normally, your tax liability would become around 26,000 rupees. Just because your income increased by 1 lakh rupees, you are required to pay now 26,000 rupees of taxes, which uh, does not make any sense, right? So in this context, the concept of marginal relief has been extended. Now, under marginal tax relief, it has been said that if your income is crossing the threshold limit, in that case, instead of collecting the entire amount of tax, the amount of that increase will be collected from you as taxes, right? But this has a stopping point. The stopping point for this marginal relief is 7,27,777. Now, if you calculate the tax on this amount under the new tax regime, you will see on this level of income, marginal relief is coming exactly to 7,27,777, right? So this is a point of indifference. If your income is more than this 727,777, in that case, the marginal relief will not be attracted. If your income is lesser than that, in that case, marginal relief will be attracted. Also, under the new tax regime, higher surcharge rate percentage has been withdrawn. Now, let's try to understand whether the new tax regime is actually beneficial for you or not. For this comparison purposes, we have taken a salary income of 16 lakh rupees and we have assumed there are a slew of deduction available for you. Like there is a home loan interest going on, there is ATC deduction going on, there is health insurance premium going on, your employer's contribution to NPS is there, your own contribution to NPS is there, all these things. Now, if we consider everything under the old tax regime, my total taxable income will come to 10,50,000 rupees. Over here, we are considering you only have your salary income. There is no other sources of income. Right. Now, under the new tax regime, there are only two deductions out of available deductions, that is standard deduction of 50,000 rupees, one, and number two, employer contribution towards national pension scheme, that is 50,000 rupees. So after these two deduction, my total taxable income under the new tax regime would come to 15 lakh rupees. Now, based on these slabs, we can see that under the new tax regime, my tax is coming to 1,50,000 rupees, and says health and education says, which is applied at the rate of 4% on the tax amount, will come to 1,56,000 rupees, right? Under the old tax regime, though, my income tax will come to 1,27,500 rupees, and health and education says of 4%, if I include it, it will be 5,001 lakh rupees, 1,000 rupees. Total tax payable is 1,32,600 rupees. So for the time being, it looks like the old tax regime is still beneficial for the person who has a lot of investment going on. Now, if you have missed proof submission, in that case, what will happen? Simply put, at that point of time, it will be assumed that you have not made any investment and tax will be calculated accordingly, and you could see a huge amount of tax outflow from your side. Now, uh, that can be remedied at the time of filing the income tax return, because at the time of filing your income tax return, you can show this amount to the CA to compute, or if you are filing on your own, you can compute the deduction based on the rules, and you can claim the amount as deduction. Second point is, if you are switching jobs during the year, there is one point I would like to point out. That is, if you are switching job during the year, please submit all the previous employment's earning and tax deduction to your current employer. Because if they do not get this information, in that scenario, they will consider this to be your first employment, and they will give you the basic exemption limit, the 80C deduction, the 80D deduction, standard deduction all over again. And your taxable income will come down drastically, and you would pay a very, very less amount of taxes. Now, you are supposed to get this basic exemption limit, 80C deduction, HRA, etc., only once a year. If you are getting twice from both the employers, or sometimes thrice from three of the employers, at the time of filing your income tax return, you could see a huge amount of tax outflow along with interest. And that could be a really awful situation to face. So, one point you should be keeping always in mind, that look for your pay slip. If you are switching the job, definitely it is for a higher amount of salary. If you are switching job for a higher amount of salary, consequently your tax liability or tax deduction should go up as well. If it is not going up, if it is coming down, or if it is remaining the same, then there might be some issue with the tax computation or income computation. So please, if you are suspecting that something is not right, you can check your tax computation sheet and let your HR know about the situation. Now that's it from my side. So we will open the floor for some question and answer. Let's see. Okay. All right. So someone is asking that the home loan is on my name and my spouse's name. Will both of us be able to claim the deduction? Yes, if the property is co-owned and loan is co-borrowed, definitely both of you can claim it. However, it will be split between you two on 50-50 basis. So both of you will be able to claim whatever the amount you have paid, 50% of it in your tax return, 50% of it in your spouse's tax return. Okay, so someone is asking what can be the proof for HRA, right? So for HRA, I am assuming at the time of filing the tax return, at the time of filing the tax return, there has to be some, rental agreement or rent receipt and pay slip, which would aid you to compute the HRA. At the time of filing the income tax return, you are not supposed to show this or attach all these things in your tax return, because there is no option for it. But to compute the exact amount of HRA, these documents are needed. All right. So someone is asking, if I am there outside India earning some amount, what will be the tax repercussion of it? Okay. So firstly, we need to determine whether you are a tax resident of India. If you become a tax resident of India, then your global income will be taxed in India. And whatever amount of taxes you have paid outside India, that can be given to you as tax credit. Right. To claim that tax credit, there is one specific form, that is Form 67, that needs to be filed. And whatever amount of tax you have paid outside India, that proof needs to be attached in that form 67. Okay, so I believe I addressed this question during the webinar. However, I am going to answer this question all over again for your benefit. So the question is, uh, my parent is admitted for a daycare facility, but the insurance provider has not admitted the claim. Can I claim the medical expenses? So again, the answer is, since your parent is covered under a medical insurance policy already, just because the claim is not admitted, the expenses will not be given to you because your parent is already covered under a medical insurance policy. All right, so this is another interesting question and in line with medical insurance. So it says, okay, one of my parent is a senior citizen. So what will be the limit in that case? In case any one of your parent is a senior citizen, the extended limit of 50,000 rupees shall be present for you. There is no need for both the parents to be senior citizen to claim the higher deduction limit. If one of them are senior citizen, then the higher limit will be allocated to you. All right, we have a few minutes in our hand right now. If you have any question, you can drop those. Okay, right. So we are getting one question that in lieu of rent receipt, can rental agreement be present? Yes, definitely. If rental receipt are not present, you can use rent agreement to calculate HRA. Again, there is no need for you to upload this or attach this in your income tax return. But to compute the exact amount, you shall require this. Right. So we are actually coming very close to our session. So we are going to stop our session right now. Thank you all for joining with us. And if you need any assistance, do let us know so that we can catch up and address those questions. Thank you all for joining with us. Have a great time. Great day.